Hello, everybody. Hey, welcome to our next stop on the Note Nation Top 42 as we roll into the Motor City of Detroit, Michigan. Honored to have you guys here with us today. Whenever you're watching this, make sure you leave a comment in the chat roll. We like to make sure and answer those questions, see where you're at, and really just kind of make sure we follow up with you, make sure you get a replay of this. And as we see deals in the Detroit market, guess what? You'll be the ones to see those stuff as it comes across our desk. But anyway, we're honored to have you guys here on the Note Nation Top 42 as we roll into the last 5 or 6 cities across the country. It's definitely been an up and down ride with a variety of different markets and numbers, and it really just been kind of an amazing ride here as we get rock and rolling. But anyway, we've got a variety of different local and national investors that are also investing in Detroit, taking a big interest in the Motor City. So we encourage you guys here to, like I said, comment, listen wherever you're at and where you're looking from. You can always check out our full lineup of cities by going to the NoteNationTop40.com website. Check out the past cities we visited and the future cities that we have yet on the roadshow. You can always click on the links and watch the replays as well. So honored to have you guys join us on here as it's been a fun ride over the last month here for everybody. But we'll be discussing the different statistics and numbers that are going on in Detroit. We'll also be talking about future opportunities, where to look for deals, and how to get started looking for real estate deals, specifically in the note and distressed debt game out there. But anyway, everybody, if you don't know who I am, my name is Scott Carson. I've been an active real estate investor since 2002. I am the CEO of WeCloseNotes.com, which has been around for over 11 years in teaching real estate investors how to tap into distressed debt. I've purchased over $500 million in mortgages on residential and commercial properties across the country. I've been working with real estate investors on distressed assets, whether it's foreclosures, door knocking, short sales since 2004. I'm also the host of the very popular podcast, The Note Closer Show, which is nationally syndicated across the country. And you can listen to it anywhere that you get your podcasts out there. So I invest all across the country, even though Austin, Texas is home. Detroit, I've been a fan of Detroit and Michigan for the last 5-6 years. I've actually bought a note. One of my first notes I bought was in Detroit back in 2008, paid $500 for a property there and sold it for scrap metal for $1,500 the next day. So I actually like Detroit. I love Michigan. I think it's a beautiful state and own quite a bit of real estate up in that neck of the woods. So anyway, our mission has always been to help investors to accomplish their goals and dreams and increase their wealth through debt investing out there, ladies and gentlemen. And, a lot of people have asked me, why am I spending time over a month targeting 40 cities with changing information, changing numbers, and it being just kind of a distressed time out there? And it's because of a couple of things. One, I love helping people, specifically investors. I've been doing this for almost 20 years now as an investor, working with people long before that, from the time I was in the 4th grade on. I love helping investors and people identify opportunities that are out there for everybody. I am also a big fan of helping people solve problems. We have enough people really struggling, they're small business owners, renters, property owners that have problems that need some help, and I like helping to solve that. I think that's one of my biggest love languages, being the problem solver. I do believe that what's going on right now is a huge and amazing opportunity. I think this is one of the opportunities of the next 2-3 years that's going to foresee us a lot of times. And if you take advantage of what's going on in the market right now, it can be life-changing for not only you, but your family and other opportunities out there as well for you. I'm also very passionate about doing this because I was once a distressed borrower back in the day, struggling, avoiding foreclosure. I was able to do a forbearance agreement and stay in my house. I understand and empathize with those that are struggling right now because it's not a good position to be in. It's stressful. And I think there is an opportunity to create, like I said, some win-wins and opportunities to help people stay in their houses and still make great returns on our investment as well for you. And we all believe, everybody, not only believe, but know that when you help somebody, it goes a long way. There's nothing greater in life than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. Homeownership often for a lot of people seems like impossible, and then they get into it and they're excited about it. But when you have something like this that's happening now, something that happened like 12 years ago, a lot of people's dreams turn into nightmares. And I think we as investors are the ones that have to solve this. The government's not going to solve it. They're just going to put a Band-Aid on it, and it's still going to have enough people that fall through the cracks. So I think it's up to us as real estate investors, that you're local to Detroit or not, to make a lot of good happen out there. And we've set a big goal. Part of the reason why I'm doing this also as well, we set a big goal to help create 1,000+ investors in the debt space over the next 12 months. So, somebody asked me today, Scott, where really are the opportunities? Where are the opportunities at? And I'll tell you right now, the opportunities are everywhere, ladies and gentlemen. They're all around us. No matter what type of asset class you're looking for, there are a lot of opportunities. You just got to know where to look and who to talk to, whether it's self-storage, apartments, single-family homes, mobile home parks or individual mobile homes, or you're looking for office space, or you're looking for hotels, motels. There are opportunities in just about every class out there if you know where to look and who's got stuff. And the most amazing thing right now, everybody, is that the banks are on sale. The United States is on sale, and you look at all the numbers and what's going on. And we don't care what color skin you are, how old or how young you are. The banks just want somebody that can perform on stuff. If you've ever wanted to change the outcome or change your trajectory, hey, now is an amazing time to do it. And I don't care if you've been through ups and downs. I don't care if you've been a successful business owner or a failed business owner. Learn from the School of Hard Knocks, got a college degree. It doesn't matter, because the opportunity exists for all of us right now if you know where to look. The banks don't care about any of those details. All they care is that you can fund and perform and can close on some stuff. And we'll talk about how to tap on that stuff here in a few minutes. But literally, everybody, we've all got different goals and dreams of what we want to accomplish for ourselves. Maybe for some of you, it's to retire on the beach drinking pina coladas. Maybe it's to spend more time with your spouse, have them leave their job to be able to travel, do more. Maybe it's more so about putting your kids through school. We know that's an interesting thing right now. Maybe it's to retire your parents. Maybe it's once you want to, maybe you want to travel more. Maybe you actually want to take a vacation versus a 6-month staycation like a lot of us have been on. Or maybe you just want to upgrade by buying more real estate or other things out there. Whatever your goal is, it's a beautiful thing. And it's your goal. But if you don't know how to accomplish that, most people end up getting bogged down by looking at the fact that, oh, I want to do all this stuff, but I don't have enough money in my account. I don't have enough money to make things happen. And what I'm going to tell you tonight, I've been doing this for 12 years now, is that there's a lot of opportunity out there. There's a lot of private capital. You don't need to have your own credit. You don't need to have your own money to do the things that you want to do to accomplish your goals. If you are coachable, if you can do the things that I teach you how to do, and others have been doing it for years, you can really make your dreams come true. All right? You totally can. Just got to put a plan of action in place and get rocking and rolling for you. So first of all, let's dive into what the national numbers say. Some of the new numbers have come out in the last couple of days. There's still 11.1% unemployment rate through June. July's numbers have not yet been released yet. I'm expecting them any day, probably tomorrow to release, but I expect that number to roughly probably stay about the same, maybe come down a little bit. But currently there are 50 million plus people have filed for unemployment. Ouch. 50 million plus have filed for unemployment. And some of them have yet to receive benefits 3, 4, 5, 6 weeks after they filed for unemployment. We know that probably half of the small businesses out there are going to fail, if not get worse here, and get a whole lot worse as this continues to go on. Before all this took place, 10% of homeowners were already struggling to stay current. Yes, 1 out of 10 homeowners was already 30 days behind their mortgage, ladies and gentlemen. Okay? Currently, the national mortgage delinquency rate is now up to 8.22%. That's up almost a full point from when it was released last month, from 7.7 to 8.22. Yes, that's not a good thing to see the delinquency rate going up. That means more people are falling behind by more than 90 days late on their mortgage. Now, also, numbers have increased. We're seeing 4.2 million Americans currently in default, with another estimate around somewhere around 4 million in that pipeline rolling into that 90-day delay. If you think about something here, that's something, I mean, if you look back in history and you look back, for us to get from 1 to 1.6 million defaults, it took us 18 months when this happened in the Great Recession back 10 years ago, 12 years ago, 18 months to get to 1.6. Well, we're at 4.2 in 6 months, not 18 months. Is the number going to stay good? Is it going to stay like there's going to fall? No, I think it's going to get a whole lot worse out there, not only on the residential side, but also the commercial side out there. And we're already seeing some things that are causing things to get a little bit ugly out there. We'll talk about that a little bit later. So let's talk about what's going on in Michigan. First and foremost, has Michigan been hit hard or doing well? And it's kind of hard to tell when you look at unemployment and delinquency rates and trying to figure out how your state ranks, okay? And there's a housing hardship index that the bank rate has come out with, and what they do is they evaluate things. Now, Michigan is by far not the worst. It's not the best either out there. When you look at the Michigan ranks, as far as unemployment across the state's at 14.8%. Woo! 20% higher than the national average. That's not a good thing, okay? That's not a good thing. It's not surprising, though, I think, for a lot of people that understand that stuff. You look at the delinquency rate, the mortgage delinquency rate, though, is actually down compared to what it is. But that's not been adjusted. That's about a point less than what the original mortgage rate, default rate was as of last month. That number may go up a little bit, though, as we continue to see unemployment rates increase. So that puts, I hate to say this, but it puts Michigan in the top 10 nationally. Yeah. Number 10. Okay. Michigan's got a bit of a hard time. Even though it's a very affordable market compared to other places out there, it's still difficult because of jobs and other things going on out there. So yes, Michigan ranks in the top 10 worst when it comes to housing hardships out there. Now, looking at the unemployment rate of Michigan versus Detroit and some other places out there, you can see Michigan peaked at 24% in April. It came down to 21.3 in May. June's numbers are at 14.8 across the state. Now, Detroit, Warren, Dearborn, the whole area out that neck of woods, peaked at 24.2 in April. Came down a little bit in May, but as of June, it's still at 17.8. You're still 3 points higher than the rest of Michigan. Okay, we know Michigan's always got a little bit of higher unemployment rate than other parts of the country. And you look at it how it's always been that way. You know, Detroit's always been a little bit higher than the rest of the state out there. Now, looking at kind of the Detroit area, county-wise, you can see Detroit 17.8, United States 11.2. Macomb County is at 18.2, Oakland's at 14.7, St. Clair's at 17.8, and Wayne County is at 20.7. So that's, somewhere between 1 in 5 and 1 in 6 people are unemployed in Michigan in the Detroit area. Okay, now that obviously leads to, if people aren't paying, people aren't working, they don't have any income coming in, and have a hard time paying bills. You start looking at the foreclosure trends. Now, what is nice is that if you look at all of Detroit, for the most part, 1 out of every 11,000 homes are facing foreclosure, but you do have some higher hit zip codes there. You have 48211 has 1 in every basically 3,300 homes facing foreclosure. 48238 is 1 every basically 6. So you got a bit of a jump there, but you can see that line right across Detroit there. You have it, the haves and the have-nots. You have some that have and others that don't. And if you're going to be targeting areas, there you go. There's the zip codes that you would want to be targeting for 8211 right there. Okay. Now, if you compare it over month, especially for July, obviously a little bit of an increase of 250% in auctions because things have started to get started back up a little bit there. Obviously, things came to a halt for the most part in February, had very zero. You've had obviously a foreclosure and eviction moratorium that's kind of coming to an end. You can see how the numbers really spiked in January, and then it came basically to nothing right now. We're going to see numbers start to increase, especially for August, and then, well, not really much in August, but really start in September, October, in the last third of the year. Okay, now if you look at how Michigan ranks compared to other states out there, Michigan, started to do some stuff. Evictions have already resumed, but there's been a delay on that. Detroit's eviction moratorium ends this Saturday night. Okay. There are some options in place. The city's come up with, I think, a $6.4 million fund. If you are behind, you need to talk with your tenant in a variety of things. Now, the nice thing is that if you are in a government-backed loan or renting a house or renting a place that is government-backed, the president has enacted an executive order to delay things on that aspect until the end of August. Now, what happens after that? Who knows? Who knows what's going to happen over the next 2 weeks? A variety of things. Now, looking at the foreclosure auction basis, you can see things are starting to get back a little bit back to normal. Michigan's at 7% of what it was before all this stuff ended. Not nearly the highest, but also not the lowest out there. When you look at some of the other states out there, there is talk that the governor may delay things a little bit more. What you have to realize is that there is talk about the tsunami of foreclosures as borrowers get further behind and sink underwater. The government is kind of kicking the can down the road and delaying things, hoping things will start back up. But when you have businesses going out of business, people not going to work, the banks can't keep delaying things, and the government can't keep writing checks and bailing people out. And if you look at the type of loans that are in default, it's kind of falling on one aspect of things. You've got the FHA loans, you've got conventional loans, you have VAs and all other loans for the most part. Now this number is for their June, and it's kind of surprised. FHA was leading the way at 9.69% of all FHA loans were in default. Part of that is the fact that you've gotten a lot of borrowers the last 2 years who've gotten to a house with basically nothing down. An FHA loan requires 3.5% down. Well, how are they getting it down? Well, the lenders that's doing the loan is donating that 3.5%, and they're also paying closing costs in a big chunk. Bank of America is getting fat on doing this stuff. And you compare it to the other rest of the loans, your other loans are at 4.65, your VA loans are roughly 4.6, 4.3, and then your conventional loans are at 3.16. Is a complete opposite switch. Well, the numbers came out just 2 days ago, and what the FHA loans have now accelerated to, and it's gotten worse. All right, it's sitting at 15.6% default rate. And that number is going to continue to climb as things happen out there. I would not be surprised if next month we see it at 20% or more. Because literally, that you look at that over month, that's roughly a 65-70% jump from June. Yeah. First-time home buyers are usually primary, especially if you look at the Detroit market, is at $150,000, $200,000 home or less. That's that way across the country. People are really hit hard if their hours are reduced. They're not making huge salaries, especially if they're working for small business. They may not have a lot of benefits. So that's the thing to keep in mind. First-time home buyers are trying to get in a house. Their budget mindset, if they lose hours or laid off, it can be very drastic immediately, and we're starting to see that, okay? Now, forbearance agreements, they keep dropping a little bit, and people ask, well, how can we have forbearance agreements continue to drop, but default rates go up? That doesn't make any sense. I agree it doesn't make any sense, but you have to look at, there's still roughly somewhere between 4.1, 4.6 million borrowers in forbearance agreements. The Mortgage News Daily, or the MBA, Mortgage Bank Association, estimates there's another 4 million borrowers out there that should probably be in a loan mod as well, because the fact is they're behind. They just have not reached out to their banks. They have not talked to anybody there. A little spread is scared. And so that number is going to get worse, ladies and gentlemen. It is going to get worse out there. So is this good news or bad news? It all depends on which side you're on for you, okay? Good news or bad news? Well, Michigan does have lower default rates than the national average across the board, but you'll have a huge unemployment rate. So that number is going to change, I think, for a little bit here in Michigan over the next 60 to 90 days as we get near the end of the year. What's been nice has been that eviction and moratorium stop. We'll see what happens starting next month. All right. Now, Michigan, if you're going to look at FHAs, it's a 390-day start to finish to foreclose on an FHA, and Michigan is a non-judicial state, usually a pretty fast foreclosure state, faster eviction state, which is great if you're a real estate investor. But if that thing's delayed, you got to be careful. Now you add in the backlog of forbearance agreements, people starting to file bankruptcy, evictions starting to increase, the courts are going to be pretty backlogged for a while. So it's going to be a good probably 12 to 18 to 24 months before you start seeing a lot of foreclosures, REOs, real estate owned, hitting the market for investors to pick up the property, okay? Now, what about commercial debt? Let's talk about the commercial loans. Commercial loans have been I think you've heard this before as well, been getting hit hard too, okay? We are seeing for rent signs, you're seeing boarded up signs. I mean, Detroit's had a pretty tough time anyway over the last couple of years anyway with this stuff. But when you look at, Flint and Michigan, that was hit really hard in the subprime mortgage debacle 12 years ago. You've had a lot of businesses that have struggled to ever come back into Michigan, and it's going to get worse out there. There's been talk that commercial debt has been on an increase. It's just been booming like crazy. I've been saying I think commercial's been overpriced for the last 12 to 24 months. A lot of Wall Street guys have said the same thing. And here you go, everybody. The commercial boom has ended. If you did not know this already, it's already ended. Because you have a variety of commercial assets that are in default. And if you look at the variety of different commercial assets, obviously hotels, lodging is stinking it up. Over 27% default rate across that. Retail has been on life support for a while. They expect only one out of every 2 malls to survive. Strip malls been struggling with. You have others. Restaurant space has been obviously hit hard too for everything out there. And if you look at the CMBS guys, they're the biggest 15 metropolitan areas are all roughly seeing a big chunk, from $500,000 to roughly a couple billion on distressed debt. Now, if you look to the south of Detroit, you got Chicago. You look to the north, you've got Minneapolis, both of the $2 billion range. Michigan, I mean, especially Detroit's going to have somewhere in that $500 to $750 billion of distressed CMBS debt out there now. If you look at some of the commercial numbers, it's a tough time. There's basically 1 in 4 hotels are in default. Okay. And that number may climb to 1 out of every 3 hotels are in default. If you look at retail, 1 out of every 5 is in default. They're expecting that number to climb to 1 in 4 as it gets worse. You expect a 15% vacancy rate for retail and restaurant space across the country. It's going to be worse in other places. Office vacancy is set to increase to roughly 20% nationwide, and Detroit's going to be hit hard there. Rents are expected to fall 10.5% before the year is out, and that number is going to increase maybe to another 5 or 10% moving into next year. Now, the thing that you have to keep in mind, everybody, is it's not all the big boys that finance this stuff. While the CMBS guys financed a big chunk of this stuff over the last time that we had this happen, the banks, your local banks, your bigger banks have gotten into financing actually over half of the distressed debt right now, 54% of that. Now, when a bank finances a property, they're not financing at 95%. They're financing somewhere in the 60%, 60 to 70% range of as-is value. Okay, depending on the asset class, it might be 60, maybe 69, might be even up to 70%. But the thing to keep in mind, though, is this huge tsunami of commercial debt, because the banks are seeing a lot of defaults. And when you talk about rent rates dropping, tenants stopping to pay rent, or businesses going out of business, your commercial asset values drop. All right? You have values that drop. And then what does that mean? Well, now the bank is not at 65%, they're at 75, or they're at 80%, somewhere in there, depending on what's going on. The banks then are going to reach back out to the borrower and say, listen, hey, we've given you some time. We've pretended and extended this for you. You need to bring 5, 10, 15% cash to write this loan down to keep us at that comfort level. We all know what happens with that is that most of the borrowers out there don't have cash reserves, don't have a huge amount of stuff out there. So then what happens? Then the bank is forced to forced to foreclose and start special servicing on that. Now, what's the strategy for that? Well, if you're going to be a real estate investor and you're going to take advantage of what's going on right now, you got to bring cash to the table and buy some of these loans, and either A, work out with the current borrowers, because you can buy this debt at a big discount. You got a lot of flexibility than the originating company, or try to reposition the property in a variety of ways. And we'll talk about repositioning some of the different asset classes in a few minutes here. Now, the banks, the bigger banks out there, even the smaller banks, but the banks are expecting to lose somewhere around $48 billion in commercial real estate loans. Now, that's from July. I think that number is actually quite a bit worse. I think it's probably 20 to 30 billion more than that. Because if you look at what they've disclosed and what they're talking about, it's gonna be a rough time for some of these bigger banks who've gotten fat on these loans. B of A, they announced, Wells Fargo announced, Chase, Citi, the big four announced that they're all struggling with it. B of A setting aside at least $5.1 billion to help start offsetting some of these sour loans. Now, that was the first part they announced back in July, a couple weeks ago. Now, it's gotten worse. All right, America's 4 largest banks report at least $151 billion in loans with payments in deferral at mid-year. Okay, that's why I say that number is going to get a lot worse. Now, it may be just $48 billion in the commercial stuff, but I think that number is going to continue to grow and skyrocket. All 4 of the big 4, that's why I say the numbers are going to be big. All 4 of the big 4 have got some major issues out there. They've all set aside, the 4 of them have set aside a combined $32 billion for loan losses in the second quarter. Close to a record, everybody. Okay, that's not going to even get close enough to staving off the bad numbers out there. Are you looking at some of the numbers? Wells Fargo, $35 billion of first and second mortgages, representing 12% and 10% of each loan type. Okay, almost 9% of JP Morgan's residential real estate portfolio was subject to payment deferrals. Okay, representing nearly 3/4 of the total $28.3 billion of consumer loans in deferral. Wells Fargo, $44.2 billion. Okay, modified $38.2 billion of commercial loans without disclosing the amount remaining in deferral. Okay, Citigroup over $20 billion. Bank of America, that was referring to payments of $7.7 billion in commercial loans and $28.5 billion in consumer and small business debt. This is what I'm trying to get at. This is just a drop in the bucket, and nobody's really talking about this unless you know what you're looking at. So where are the opportunities? Is it going to be any opportunity to be in buying foreclosures and REOs? No, because that's 6, 12, 24 months out. That's not the play if you're wanting to find some deals with what's going on. Is it going to be in the fix and flip market? No. I'm not going to say that, because you got to wait for the REOs. You're going to wait. Even the mezzanine lenders and the hard money guys are pulling back on what they're doing, especially a lot of the lending opportunities, once again, have been dried up. Is it going to be in the rental market? No, I don't think you want to be in the rental market, especially with all the unemployment in specific parts of the cities. I would not want to be the operator. Now, the real opportunity lies for those in the debt game. If you come in and buy that debt at substantial discounts, okay, huge discounts, which you can currently, we're already seeing stuff on the hotel selling at 20 cents on the dollar or less, okay? Already seeing some huge discounts, especially some of this commercial stuff. And we are going to see probably some residential notes in the fourth quarter. Notes, and not REO, not property. As the banks have now had 6 months to look at their, who's been paying, who's not been paying, who's on the naughty list, for not paying, who's on the nice list. They're going to keep the nice list. The naughty list, they're going to look to offset that and sell those off to somebody else to deal with into the next year. Well, if you buy it at a discount, you may have some flexibility there to really still keep the borrowers in place or allow them to get back on their feet, whether it is single family homes or even the commercial space, because there are already commercial deals hitting the market right now that is a tough time, okay? Tough time for the banks that have this stuff, but it's a opportunity for us. I've got my buddies in Wall Street and New York and everything saying they're seeing more deals now in the last 2 months than they've seen in the last 24 to 36 months. Deals actually make sense. A lot of the big guys out to the big funds, they've been holding capital back to tap into this opportunity as well for everybody. Now, the biggest opportunity isn't going to be those bigger assets, the 5 million plus. Really, the big opportunity that's really clogging up the bank's arteries for the most part is that smaller commercial balance stuff, that below $5 million value, really a $2.5 million value or less. That's where we as real estate investors and own our local market can make a big amount of opportunity, because that's the stuff that the banks want to get off their books and they're motivated to do it. All right. You can come and buy something very inexpensive, work with the tenants, work out with them some sort of fashion, or take the property back if they need to and own or operate in some sort of fashion. Okay. Now, we talked about pivoting earlier on. You need to be expecting to pivot in some sort of cases. Suburban hotel turned apartments for sale. This happened in Illinois, in Arlington, Illinois. Somebody took a hotel that was newly released or newly built, and they said, oh, crap, let's not do this because it's not going to rent out, especially when hotels being dropped down. So they were the smart thing. They turned it into apartments and sold the apartments off in a nice thing. Our buddy Garrison Gilbert is doing this in Pennsylvania. He's doing it in Maryland and a couple of places out there, taking smaller hotels that have been forced to shut down for a period of time or go out of business and looking to pivot the asset into something that makes sense. Office space. We know office space has been being hit hard. My buddy here in Colorado is taking his 110-unit office space and converting it to self-storage there because there's a big need for that in a downtown market. People are storing their office equipment into his office because we know that's going to happen for a period of time. And so when you have that, you can reduce costs because now you don't need to hire full-time staff to take care of your office. You just need somebody on there basically to handle the rents or the incoming in and outgoing. All right. And that's a beautiful play. Now, are there banks in trouble? Yes, there are banks in trouble all across the country. We know that with the big four. But there's more banks out there than just Bank of America, Chase, Citibank, Wells Fargo. Okay. And one of the things that we track is the Bauer Financial List. Okay. The Bauer Financial List is Bauer Financial is a company that evaluates banks as they file in their quarterly reports. They also get credit unions and stuff like that. And they provide a quarterly update. The most recent one was June because that's when the banks file. Now, when you look at the Bauer Financial numbers, it's going to break down each bank and rank them from 0 stars to 5 stars. It's also going to show you exactly off their quarterly reports, what do they have in defaults, what do they have in 90-day lates, 30 to 89-day lates, what do they have in commercial, what do they have in residential, what do they have in multifamily, what percentage of their portfolio is part of their default stuff, what did they rank last quarter, this quarter, that kind of stuff. So this is a list that we love to look at because it helps us identify opportunities out there, big banks and smaller banks. Now, we like to pull a report for banks that have 5 or more branches because anything really less than 5 branches, they're going to be really too conservative, really small, can't really take too big. That's not saying they're not going to have deals, but I'd rather deal with an opportunity with my marketing to work better versus working harder. Okay. So when you look at the list, when you pull a list of just 5 banks that have 5 branches or more, it comes out to about 1,600 branches or banks across the country. When you narrow that list down to get a snapshot and looked at who's based in Michigan, we know there's thousands of banks with offices across Michigan, but there's just basically 46 that are based there in Michigan that have 5 or more branches. Now, looking at this 46, that's not everybody that lives in Michigan, but those, you get what I'm saying, okay? Between those 46, they have $692 million in distressed debt. Distressed debt that's 90 days or greater, and they've got an additional $331 million in 30 to 89-day default. So basically, if you look at this, they've got over $1 billion, okay, 1.2 billion, roughly, basically in trouble out there. Now, it averages out to roughly 5.58, 5.6% of each bank's loans are 90 days past due. That's not a good point. Banks don't want to see that. They want to keep that down, okay? Now, if you divide that up between residential commercial, they've 228 million in single-family homes in default. So basically a third roughly is in single-family homes there, and the rest is commercial side. Now, the biggest banks that are in trouble facing the biggest things, it's kind of a surprise a little bit. You have one big bank and one kind of small bank if you look at things. So you look at Flagstar Bank, big lender lending across the country and a variety of things. They currently have 545 million in 90-plus day defaults. Okay, they have another 205 million in 30 to 89. So they're the biggest contributor of these 46. The rest of them are like, okay, we're doing okay. You still got your hit and stuff there, but with their branches across Michigan and what they have in other states, they've got a lot of stuff on their books. Now, looking at the next biggest bank out there, it's Central Savings Bank. They've got roughly 18.6% of their total balance in 90-day defaults. That's not a good place to be, okay? Bank gets over double digits in their default rates. That's not a good place to be. So those are some opportunities there for theirs. There's more banks lending in Michigan than those that have office there. I just wanted to give you guys a snapshot to see kind of what's going on out there, okay? Now, why would you want to buy distressed debt? Why would you want to reach out to the bank and say, hey, I'll buy your notes from you? Well, for a couple of things. One, you start doing deals now versus waiting for foreclosures. You could wait around to the very end and then you're going to be outbid because that's the most overvalued real estate in the foreclosure market. Yeah, you got people fighting for it, showing up for it. When you're closer to the bank, you get a much better discount, bigger discount, and much cleaner assets because you're closer to the source. Now, there's a variety of different things that you can do on that debt and to get a big discount depending on the location, the foreclosure timeframes, the values, the condition, the asset class. Okay, and there's a lot of great things that you can do to work in your favor to get a bigger discount. Now, the nice thing too is if you need to, you purchase a debt, control the asset because you're in the first lien position, and get a huge discount, somewhere between 30 and 70% off. I wouldn't buy anything less than 30% off. That's at 70% of as is value. I'm not talking about 6 months ago value, or future values. No, I'm talking about as is values right now. Yes, some significant discounts. Now, the beautiful thing is you've got a variety of exit strategies to make money on these. You can offer a loan reinstatement, a modification, a short sale, short payoff, foreclosures, loan sale to somebody else, deed in lieu, cash for keys, let your borrower walk. If the borrower files bankruptcy, guess what? That works in your favor to be a loan mod or a forbearance agreement or to get the property back. Okay. Take over the note and turn it into a reperforming note or a cash flow, or if you're wanting to grow your asset class by taking over the property and doing what you want with offering the borrower to walk away or foreclosing and going that route. Now, there are some other advantages out there. I know a lot of real estate investors, they want to get into real estate investing, but they don't have a big budget for marketing, okay? Because everybody out there in dog is teaching them, hey, go out and send postcards, yellow letters, door knockers, bandit signs. Blech, none of that. We don't do any of that stuff in the note space, okay? If you can be in the 21st century as far as it comes to technology, all right? And what I mean by that, if you can send some emails, if you can jump on LinkedIn and connect with asset managers, or jump on the phone and dial for dollars on a list that we pull, guess what? You can do that stuff now. And no, you don't have to work 40, 50, 60 hours a week. No, you don't have to drop 1,000 postcards to get a 1 to 4% response rate. You don't have to do that. One source, one bank will lead to regular deal flow, not like other real estate. Oh, you got to send out a ton of letters to get one asset from one borrower and hope to go do it all over again. I've never found that to make sense. Why, when I could go directly to the banks and start getting stuff if I just spent a little time and market it properly to get in the right departments. Okay, but unfortunately, 90% of investors, they love the foreclosure model and that aspect of things. That's great. You can have it. I'll take my niche and get direct from the source and buy deals that will never end up going to the foreclosure market. I'll see the deals 6 to 12 months ahead of most real estate investors. Now, when I get a list, I can cherry pick it for my own portfolio if I want to. I can say no and pass it on. I could wholesale it to somebody else if it makes sense. I can buy in bulk if it makes sense. I get even better pricing instead of buying one-offs. I can do it. A lot of the marketing I do, the same thing would be for residential or commercial assets, depending on where I'm targeting and what type of lenders I'm looking to. Okay. I can raise capital from other investors to fund purchases. That's the thing, ladies and gentlemen. You don't have to write a check with your own capital. You're not going to be using your own credit to fund it. The bank doesn't care what your FICO score is. Bank doesn't care if you're in a forbearance agreement in your own house. All they care about is, A, do you have the money that you can wire in to close on this thing in 30, 45, 60 days? And are you not going to embarrass us? Okay. Are you going to actually be able to take these down and do something with it? Okay. That's all the banks care. Can you buy something? Can you close by the time you say you're going to do, or even delay it and still close? That's what the banks care. Can you buy something and get the stuff off our books? Because if we can get in 30 cents on the dollar, 40 cents on the dollar, 50 cents on the dollar of what we owe, we can make up that difference over time by the way that we lend money out, by the way that banks arbitrage funds, ladies and gentlemen. You know that they're lending money, you're giving them your money at 0.1% or 0.01%, and they're making 6, 12, 19%. It's a huge return. That's why banks are always the biggest companies out there. Well, it's time for you to jump into there. Now, there are investors out there for you. Yeah, there's a ton of investors out there. You look at $9 trillion in retirement funds sitting out there, ladies and gentlemen. $9 trillion sitting on the sidelines making really less than 4% or less than 2% in most cases. Now, if you look at Detroit area, let's talk about Detroit, okay? Detroit's got quite a few in local investors, pretty good sized city. There are 50,000 investors with an IRA in the Detroit area. 50,000. How do we know that? Because we can track this stuff. We were able to do that, okay? Now, out of that 50, there is a 33,000, 66% of them have at least 150 grand or more in their accounts. Yeah, I know. Most people are like, what? Where are these people hiding at? Okay. 33,000 in the Detroit area have more than 150 grand in their accounts. And I can actually pull their names, pull their addresses, their emails, and their phone numbers and zip codes for you guys. It's one of the things that we do. All right. How many people do you need to talk to make some things happen? How many people do you need to send an email blast out to raise some capital? Okay, not too many, especially if you got an amazing deal. Now, if you look at that, if you don't want to raise capital, there's 47,000 people in the Detroit area that say that they're real estate investors. That's how they file their taxes. Okay, 47,000 people say that. So instead of you, hey, if you don't want to raise capital, go find the deals and flip the deal to other investors. You can do that. Bank at this point does not care who is funding. They don't care whose name is on the final contract, just that you can get the stuff off their books and they can take your capital and go out and rinse and repeat. Now, ladies and gentlemen, all of us are in the note game. Unfortunately, most of us are on the wrong side of the payment stream. I always ask, do you want to be the bank or the borrower? Everybody says, I want to be the bank. Well, guess what? You're the borrower right now. If you're paying money out on your mortgage, your credit cards, your car, your student loan debt, your debt to Bobby Joe down the street, you're in the note game. You're just on the wrong side of the payment stream. And as we all know, the bank is going to win out there. And you have to realize, besides just all the retirement accounts, there's a record amount of savings being stowed away as people are waiting for that rainy day. They're uncertain about what is going to do in the economy. Okay? It's an opportunity for you to really become the bank, because the bank always wins, ladies and gentlemen. You've got an opportunity to step in, become the bank, buying this debt, using other people's money to fund your deals, or flipping the deal to other people and making a nice chunk of change in the middle by being a deal engineer. Okay? Marrying up the bad debt with the investors that want that debt if it's something you don't want. And we've done that for 10 plus years. Okay? We are so excited what's going on right now because we see all the opportunity for those out there that want to do some stuff. So how do you tap into the tsunami of deals? All right? It's not that difficult, ladies and gentlemen. It is really not that difficult how to do that. I've been teaching investors about notes since 2010. We've helped thousands of other investors out there buy their first non-performing note or their performing notes on both residential and commercial deals over the last 12 years. Okay. You can do it for cash flow. You can do it for asset growth, whichever one of the things you want to do. Guess what? You can do it. All right. And yes, you can buy one-offs from the bank or in bulk. Now, you're not going to buy a one-off on a single family home from Bank of America, Chase, Citi, Wells Fargo. They're just not going to sell you a one-off note. On the residential side, they will on the commercial side. Okay. And there's other smaller lenders out there, 5 branches. Remember, talk about that are looking to sell stuff. Okay. You just got to know how to talk to, who to talk to, what to say, what not to say, get things right. And no, you don't have to spend 40, 50, 60 hours a week doing this. We have a lot of our students that started off at 10 hours a week and grown into this and eventually left their jobs. And the trades aren't millions and millions of dollars. We've seen trades from 25 grand all to $5 million. There's enough private capital out there to fund that, even if you don't have the money yourself. The good deals that you will find, the debt game, the ability to do due diligence on these things is give you time to market these deals. And there are a lot of investors out there, especially if you're finding a great deal. If you know how to market or listen to what we teach, you can really make some good things happen. And like I said before, you don't need to use your credit. You're not going to go get a loan. Banks not going to check your credit before they sell you a loan. You have to use your own funds. They don't care to source and season it, okay? As I said before, if you can use email, LinkedIn, or pick up the phone and start dialing for dollars, guess what, ladies and gentlemen? You can do deals today, okay? So whatever your focus is, whether it's been single family, apartments, hotels, retail office, self-storage, mobile home parks, there are deals in all asset classes, and you can really create some win-win scenarios and win-win stories, not only for yourself and your investors, but also for the banks, but more importantly for the borrowers. The people that are the salt of the earth, living in their house for years, you know, they want to stay in their house. They've raised their kids there. They're looking to raise their kids. It's been their dream of home ownership. And now, boom, all this shit has happened. It's, you know, it's a country western song nightmare for most people. And you can step in and really give them an opportunity to really help them out because you're buying that debt at such a huge discount. They still owe it, but that gives you the flexibility that the banks don't have. Banks would rather sell you the note at 50 cents versus trying to go 6 months to 12 months to a foreclosure and drag it all out. Okay. And you can go after, you know, single family homes. If you want to go the higher end stuff, the high end stuff, there's plenty of high end stuff in default as well out there that's not government backed. Maybe you want to go to commercial. Maybe you're looking for apartments. There's plenty of smaller apartments out there all across the country that are in default that aren't government backed. When you have, it's different when you got 100 plus units, but if you've got a small unit and you got 2 or 3 people in your units that can't pay, now you're struggling to survive, struggling to pay your mortgages. And we saw a lot of this 12 years ago. We're already starting to see a lot of this right now. Okay. And I said before, you don't have to do it big right off the bat. I always tell people, hey, start off doing it small, and then you can take it big if you want to. Find out whatever that number needs to be to hit your goals. Whatever you want to do, you can work 10 hours a week. If you want to do this full-time, great, do it full-time. But if you want to start off small like many of our investors out there, just like Gene has done. Gene started off Elkhart, Indiana, getting started buying a couple onesie-twosie properties here, doing some rehabs, using his own money, scared to raise capital. And we spent some time with him and taught him, hey, do this, do that. Now, fast forward a few years later, he's closed on over 130 assets, raised over $13 million in private capital. He was scared at first, got his own fund. Retirement for Gene has a whole different definition than it did a few years ago. And we can be more proud of what he's done and what he's accomplished. So we're excited for what Gene does out there. At Elkhart, Indiana, he's buying assets all over the place. Talk about Laura Blunt. Laura's done a tremendous job. She started off, she used to live here in Austin, she's South Austin, Wimberley, Texas, moved to Maryland, living on the water, bought her dream house just recently. She was like many real estate investors, trying to run around, trying to do a variety of things, trying to use a tool in the tool belt. Oh, I hate that. Trying to wholesale, trying to raise some capital, trying to market some stuff, trying to do some options, some light fix and flips. And when you're in a competitive local market, it's tough. Austin's competitive here. All right, way overpriced, I think. She learned the note business and it really applied herself. Started off a little slow, but at the end of 18 months, she's closed on 14 deals. Fast forward a couple years later, she's closed on over 100 notes for her own portfolio, mostly with other people's money. And then she's also getting ready to close on a big trade of over 100, 140 assets, $4 million trade on performing notes that she's using other people's money for. So we're really pretty excited. She went from small to big very, very quickly. All right. Keith Collins here. one of our senior statesmen, lives out of Ohio. I think he was a mayor of a small town in Ohio at some point, but he's worked a lot in real estate, fix and flipping, commercial property. I think worked for city government building water treatment plants as well. He learned the note business from us about 3-4 years ago, has done really, really well. I got an email from him recently talking about the fact that in 2019, him and his wife made 7 figures because of what they learned from me and how we taught them how to do the business. So we get really excited about hearing stories like that. People really taking it, applying it. You're not having to go out and buy 100 assets. He's been very particular when he buys and where he looks at stuff, and boom, there's plenty of deals out there. Still, okay? A lot of people say, oh, there's no deals out there. There's always been deals because there's always been distressed debt, ladies and gentlemen. There's always been distressed debt, okay? Now, if you don't have a lot of experience, you don't have to worry about that. You could be like our buddy Raphael here. Raphael started off, doesn't even own a house. He is a business owner. He lives in San Diego, one of the most expensive places to live in the country. And he wanted to learn real estate. He just wanted to learn the note business after reading about some stuff, okay? Took our class back in November, really got started in December, really took to it like a fish in water. Bought 2 deals immediately, bought a total of 5 deals in the first 30 days. First 2 he got reperforming and the borrowers are paying on time, roughly about a 20% return to him. The other 3, selling 2 of those or sold 2 of those and doubled his money, and the 5th one he's still working through. But COVID hit San Diego hard. And for him, being a small business owner that owned a car detailing shop, he had to let his whole staff go. Nobody wants to get their car washed when they can't drive it anywhere, right? So he had to let his whole staff go, and that could have been really, really tough. I mean, it's tough to let employees go, of course. But he said, Scott, I'm not that scared. I may not reopen again, and I'm okay with that because I found something that I know I can build upon and I can actually apply, and we see a lot of opportunities going on in the market right now. So like I said, whether you start off big or small, we've helped so many people, investors all across the country, do amazing things from the East Coast to the West Coast, from Detroit to Laredo, from Cape Cod to Chula Vista, California, all across the country. I don't care where you're located at, or what your experience level is, or how old you are, what color skin you are. It does not freaking matter, ladies and gentlemen, because we can help you really take your note business, take your real estate business to a whole new level. If you are coachable and can do the things that we teach you how to do, because we've made enough mistakes out there over the last 12 years to know what to do, what not to do out there. And I'd love for you guys to be a part of that 1,000 that we're trying to help educate here. And we know we're going to hit our goals. Not trying, we're going to help them educate here and get rock and rolling in the note business over the next 12 months. And best way to do that, ladies and gentlemen, we have a very special, easy, one-day note class that we teach called Note Weekend. It's a great way for you to dip your toes in the water and see if the note business is for you. No, it's not a pitch fest. No, it's just not like a 3-hour thing. This is literally an all-day class from 9 a.m. Central Standard Time to roughly 5, 6 o'clock in the evening out there. We take a couple breaks throughout the day, but literally it's about 14, 15 sessions throughout the day of me teaching you the basics of note investing, okay? Like I said, it's a mini workshop. You're not going to learn everything about the note business in one day, but you're sure going to learn a lot about it to give you a great understanding where to go. And some people, it's all they need. They get off, start rock and rolling. Other people like, hey, this is a great start. Hey, I might need some more training. That's okay. Okay? It is not a pitch fest. It is designed here to give you a great knowledge base to understand what's going on in business. Too many people out there make it way too complicated. Buying notes is not that difficult. And yes, banks will sell to you. There are plenty of lending institutions out there that have bad debt in their books that they can get rid of. Our students call this the Cliff Notes version of note investing because it's direct, a lot of great content. I mean, I got a 20-plus page manual that goes along with it for you guys so you can follow along, you can fill in. A lot of great stuff to go in there for you. We live stream it like this via Zoom on Saturday. You restream it on Sunday too. You get the replays Sunday morning so you can watch Sunday morning to Sunday afternoon. Just depends what's going on with the internet. But literally, you get the chance to sit down and learn, okay, 9 to 5, that's 8, 9 hours there. We also include another 10 hours of videos for you to watch and learn from our vendors, our servicers, and other things like that out there for you too as well. So roughly about 20 hours of content. We normally charge $97, $99 for it. Like I said, it runs from 9 a.m. to 5. I stay around as late as need to be to answer questions. We make it very interactive. Asking questions, we bring you live on camera or with Zoom if you want to. If not, you can hang off the sides, it's fine. But we do this roughly once a month. Usually it's the 3rd to 4th Saturday of the month. Our next one is just a couple days away. All right, we'd love for you guys to be a part of that. If not, can't make it, hey, we've got one in September, one in October, we'll have one in November, and probably one in December as well. But the opportunity, guys, is not to sit around and wait till then. What's going to happen is those that take action, they start putting the things in places. The fourth quarter, the second half of the year, it will be amazing. I've already seen people, oh, what to expect in 2021? I'm like, 2021, we still got 4 months left in this year. I mean, yeah, it's been a shit show for a lot of people. A lot of people like to forget 2020, but I think it's going to be one of the most impressive years when it comes to the debt space out there, if you know what to do. Now, what do we cover? Well, if you go to noteweekend.com, that's where you get signed up. If you scroll down, you can see the schedule of the day. Now, it's kind of a loose fit. Sometimes we'll run a little faster. Sometimes we'll run a little bit longer. Sometimes we'll throw some other stuff in there as well, too, depending on what's going on in the market. Now, the first part of the day, it's all about finding deals. Okay, I'll show you what to say, what not to say. We'll talk about who to contact, who has assets, who doesn't have assets. You literally have a list of over 1,500 asset managers and banks before we walk out of there or virtually walk out of there, okay? Second part of the day is about funding. How do you fund these deals with OPM? How do we find investors in our local counties? How do we find local people to fund our deals or people in other parts of the country where those deals are at? So we go through all of that for you guys. We'll talk about the different exit strategies. There's 10 to 11 different exit strategies for you. We'll show you how to make money in each one, how each one kind of works for you. And so those three things, in the find, the fund, and the flip, are the big the basis for our class for you guys. Those are the biggest things that people need the most amount of help with. Now, we'll also spend time also on talking to the vendors and the team members that you need. That's an important part because you're not going to be the one person going out and doing all this yourself. Okay, there are vendors and service providers out there to help you with your business, not for you to be the jack of all trades. Too many real estate investors lose too much money, make too many mistakes because they're a control freak. In the note space, you're not a jack of all trades. Those are successful are more the general managers. They direct people on where and when to go, all right, and what to do. Okay, we'll also talk about the different loan trading platforms. You can look at assets now. Yes, you can look at commercial and residential assets today. You don't have to wait around for the banks to call. If you don't want to call banks or don't want to reach out to banks, you don't have to do that. You can look at the loan trading platforms that are available out there. And as always, guys, we'll cover more things than that. Some on marketing. As I said, there's over 10 hours of other videos for you to watch so you get a good feel for what it is. Like I said, Note Weekend, the Cliff Notes version of note investing. It's a one-day thing to help you give a great basis on buying distressed debt out there for you guys. Now, if you go to noteweekend.com, you can get registered today. I'll get you a link out first thing in the morning, if not later, for you to guys have a link to the actual class. You'll have a link to the replays from the previous class, and you'll be ready to rock and roll and do other things. Now, I like to throw in bonuses. Not every class we do is a little bit different bonuses. This one, we've got some special bonuses for you. All right, I'm gonna give you over $1,000 in bonuses. First and foremost, the class is starting. We're gonna cut it in half from 99 down to basically 49. Sorry. We also teach a 4-hour calling banks training. We're gonna be doing this Wednesday after the class. This is basically from 1 to 5, and this is where you get to watch me actually call banks. You get to see me dial for dollars to get hung up on, or the conversations that I have with the asset manager. You see who I call, who I talk to. You can ask questions via Zoom back and forth like this. People love this. This is normally $49 by itself. We'll throw that in there for you. And yes, if you can't make it, don't worry, we record it. You can get the recordings to watch it at your time and place as easy as for you. Okay, the Bauer Financial List. We'll actually give you the most recent quarterly list, which is roughly about $400. That'll give you the list of asset managers. You'll be able to see who is in default. You'll be able to see who has stuff that you can reach out to and really go rock and roll from there. That's worth the price of admission just there. I charge $1,000 an hour for consulting. I always love to schedule a phone call with our students after the class so we have an idea of where they're going, what they're wanting to do, what they want to focus on, what type of assets, what markets. This gives you an opportunity to ask me a lot more questions one-on-one basis that you may not want to ask during a class. Normally $1,000 an hour, cut that in half, it's $500 bonus there for you guys. All right. And yes, you're talking to me. All right. You're talking to me for sure. We always like to throw into, if you've got a spouse or business partner that you want to attend, throw that in there. We throw the replays in. The replays, like I said, are available almost immediately afterward on that Sunday for you to watch. You've got to step away so you can watch it again and again. And then, of course, we have a great Facebook group of about 900 plus real estate investors that are part of things. Great place for you to ask questions. We have somebody reaching out tonight or earlier today asking, hey, I'm looking for some help to look at these 10 assets I'm getting ready to buy. People are volunteering to drive by. If you're looking to buy some assets, hey, great, I'm looking to buy. If you're looking to sell, it's just a really great group to be able to ask questions when you've got 900 people working working with you, looking for the same thing and the same motivation. It's a beautiful thing. So all that, guys, I think it's over like $1,400, $1,500 in bonuses. We throw that in there, the class. Basically, you can get signed up tonight for just $49. Now, $49, not a big investment. We're not making money off of this. Trust me, it is just to give you a little skin in the game. Because what we want to do over the next 12 months, I said, we want 1,000 people to go through this training so that we have people that we can send assets to, or people that can send us tapes. What they call them, like, I don't want anything on there. Who can buy this? Becomes a great referral network. But free has no value, ladies and gentlemen. So $49, small investment to learn what we do and how you can tap into assets that you'll never see, discounts you'll never see in the traditional real estate space. Hey, trust me. How many letters would that be in a direct mail campaign? 49? Okay. Trust me, you'll have more sources than that before you even walk out. So, and I'll throw in one more thing here too for you guys. If you're coming through it at noon on Saturday, you're like, I don't think this is for me, Scott. I think this is too much work. I don't want to do this. Great. We'll refund your $49 and let you go your merry way. I don't want people that don't want to be involved in that. I'm not going to take your money. But if you don't show up, guess what? That's not a big, but if you show up and say, listen, I don't think this is for me, and I can tell if you show up or don't, hey, that's not for me, I'll gladly refund back your $49 for you, and we'll part as friends that way. So once again, everybody, over $1,000 in bonuses. You get the class, you bring your spouse or business partner, you get the Bauer financial list, you get the calling banks list, the 20-page plus manual with over another additional 10 hours of training, replays the last workshop, replays of this one, a one-on-one phone call with me. Guys and gals, I would love for you to be a part of this. $49 this Saturday. If you can't make this Saturday's event, guess what? We can bump you to the next month's. It's not that big a deal, okay? But price is not going to be $49 next month. All right. As we get closer to that number is going to go up there a little bit. So save your money, sign up tonight at $49, and really learn from somebody who's closed thousands of deals, who knows the ins and outs of residential commercial deal notes and how to deal with the banks, how to evaluate things, how to raise capital for you, how to get worked out, how to have the vendors ready to rock and roll for you. Like I said, guys, if you go to whatever your goal is, talked about this before, whether it's for you to retire, you need more money to retire to live the life that you want to, or maybe you want to retire your spouse. Maybe you want to put your kids through college at a better school or help them pay for it. Maybe you want to retire your mom or dad from working so hard because they didn't do a good job. Maybe you want to travel more. Maybe you want to upgrade your house or your toys. We all know it takes money, okay? It takes money to do that. And if you're going to get in the money business, you might be in the note business because the bank always lends on you, gentlemen. And we've helped thousands and thousands of investors tap into this. We've helped so many investors leave their JOB or start something new that pays for a lifestyle that is well beyond their dreams. And I'd love to be a big part of that to help you guys out there as well. So go to noteweekend.com, noteweekend.com, get signed up tonight for that, and we'll get you rocking and rolling. See you this weekend. You'll get a link sent out to you, and we'll be rocking and rolling come this weekend. So wanted to open up if there's any questions for anybody out there tonight before we let you go on your merry way. I want to thank you guys for joining us in here live. Great to everybody that was here in Zoom. Great to those that watched on Facebook. If you're watching the replay on Facebook or YouTube or anything, please feel free to comment in the sections. We love seeing comments. We love answering questions. And hey guys, I'm here to help you succeed in whatever endeavor part of your real estate is. I hope notes are a big part of it because I believe it is the opportunity that we are all looking for, even if you don't know it. So go out, take some action, everybody. And we look forward to seeing you this Saturday. See you at the top. Bye.